In a stock market environment where stocks only go up, it sticks out like a sore thumb when a particular part of the market is down 40 to 50% in a matter of a few months. So when Chinese tech stocks fell not because of their company's balance sheet, but because of a government-imposed crackdown, investors were understandably worried. A few days ago, Dalio stated that some Western investors have misconstrued China's recent regulatory tightening as anti-capitalist. Dalio stated in a note on his LinkedIn account that investors who think this way would end up missing out on what's going on in the Asian giant. In this video, I will tell you why Dalio and other famous investors are taking advantage of the fear around Chinese stocks and using this opportunity to buy the dip. I will also tell you how you can take advantage of historically high stock options premiums in these names to make a profit. Chinese stocks were hit by a sell-off as regulators tightened their grip on everything from technology to education to food delivery applications. Didi Global's stock dropped as much as 10% from its IPO price in late July on reports that Chinese regulators were preparing harsh fines against the business. Despite an examination into its data security methods, the ride-hailing service was criticized for ignoring warnings about proceeding with its market debut. The sell-off was most likely a reaction to fears that the government could compel Didi's delisting, as well as hopes for the industry's future. Over $1 trillion has been lost in Chinese technology and education stocks. Following the market reaction, the Securities and Exchange Commission announced that US-listed Chinese companies should therefore report possible risks of government interference, or they will be breaking the law. China's own watchdog is now urging the SEC to work together on the issue, ostensibly to calm investor fears. In the fast-evolving capital markets environment, Dalio advised investors to appreciate that Chinese officials are finding out acceptable regulations. So, when things change quickly and aren't clear, it leads to these kinds of misunderstandings, which can be misinterpreted as anti-capitalist activities. He went on to say that we should plan for such events in the future and invest properly. However, we must not perceive these wiggles as trends, and we should not expect the Chinese state-run economy to be identical to Western capitalism. Dalio said he is concerned by Beijing's regulatory onslaught on technology stocks like Didi, noting that the government's actions do not signify a shift in long-standing policy trends. He backed China's recent move to tighten its grip on data collecting and use across the technology industry. Following the government's crackdown, certain Chinese stocks have had their sharpest drops in 2021. In a LinkedIn post, the founder and co-chief of hedge fund Bridgewater Associates wrote that China is a state capitalist economy, which means that the government runs capitalism to represent the interests of the majority of people, and that policymakers will not let the inclinations of the capital markets or wealthy capitalists get in the way of doing what they believe is right for the country's majority. Despite recent jitters, Dalio believes that both the US and Chinese markets provide risks and opportunities, and that they are capable diversifiers. According to the hedge fund manager, these misconceptions in the West might lead to adjustments in geopolitical posture, as evidenced by the US delaying IPO listings by Chinese enterprises. Nonetheless, Dalio agreed that it is regrettable that Chinese policymakers do not explain their decisions more transparently. Last week, investors hurried to price in the mounting dangers from Beijing's escalating crackdown on certain of the country's businesses, as a sell-off in Chinese private education companies sent shockwaves through the share market. On the mainland and in Hong Kong, stocks fell sharply, with the benchmark CSI 300 index falling 3.2% and the Hang Seng index falling 4.1%, the biggest since May last year. Following a major revamp, steep losses in education equities spilled over into other sectors, with technology, healthcare, and property-related stocks all dropping. Investors are pricing in the potential that Beijing might tighten regulation on all industries that have enjoyed strong development in recent years, causing panic in the market. In Hong Kong, New Oriental Education and Technology Group Inc. fell by a record 47%. Chinese regulators released measures this week that will significantly alter the business model of private companies that teach school curriculum, as part of Beijing's effort to revamp a sector that it claims has been hijacked by capital.
The stated goal is to try to bring costs down for a lot of these parents.
Firms that teach school curriculums are prohibited from making profits, raising capital, or going public under the new restrictions. The latest reforms come on the heels of Beijing's unprecedented regulatory tightening. Global investors have fled the country as the government attempts to rein in the country's big digital giants.
We don't think it's entirely uninvestable. We know that China does want to become the largest economy in the world, wants to be the most innovative in the world as well, wants to dial down some of the mass media products and the inequity that has taken place. But I don't think it wants to shut its economy down.
Now, for how I plan to use stock options to take advantage of this pullback in Chinese tech stocks. If you take a look at stock like Alibaba, you can see that it has declined roughly 40% since last October. Also, looking at the daily chart on BABA, you can see clear divergence. On July 27th, there was a massive volume climax in BABA and 12% bounce over the following 2 days. It is my belief that BABA has bottomed in the near term, but options premiums still remain high in this volatile name. That is why I'm going to use a put spread to take advantage of this. I am selling the September 21st 190 put and buying the September 21st 185 put. At the time of this recording, this can be put on for $146 in credit with a max loss of $354. This bet wins if BABA trades sideways or goes up, but loses if continues to head even lower than this historical drop, which the charts are suggesting won't happen.